The ATR indicator is one of the most widely used indicators on our prop desk, and there's a good reason for this. In this video, one of our most seasoned prop traders, Garrett Drinan, will break down the 3 most effective ways to use this valuable indicator. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City and proud to have developed numerous 7 and even 8-figure per year traders. We hope you agree. This is the top YouTube channel to help you grow your trading account.
Garrett here from the New York City desk, and today we're going to talk about ATR. So we've gotten tons of requests lately to do a video on ATR, especially after doing the Keltner channel video, which was about an indicator based on ATR. And so you can check that out on our channel. And so we're gonna get a little nerdy today. There's some really great stuff here rooted in statistics, but also super basic and directly applicable to trading. Whether you're a model builder, a systems trader, or a fully discretionary swing trader or scalper, ATR is truly universal and all important. By the end of this video, you'll understand what ATR is and how the top traders on our desk use ATR every day to inform trading decisions. And my hope also is that you come away with some creative ideas on how to use it as well. And then in the end of this video, we'll go over 3 distinct real trading applications for this metric with examples. But first, let's dive into this metric to get a better understanding of what ATR is and how important it is. All right, so what is ATR? ATR stands for the average true range, and it represents the volatility of the stock you're trading. So this is key, right? This is so key that it's part of the common language on our desk. There are a few ways you can try to describe the volatility of a stock, but this is a really, really simple one, okay? And basically, and if you look at the chart here, it's measured by the range of the candle. So candle there on the right, you can see the high and the low. And the ATR, generally speaking, is measuring the range of these candles and adding them together. So a little story, one of my trading partners, partner at the firm, his name's Tim, and he was telling me yesterday that he has a hard time talking to his non-trader friends about trading without mentioning ATR. And he was telling me and laughing about like how frustrating this was because he was trying to have a conversation and they were talking about stocks in terms of percentage moves and dollar moves. And he kept saying ATR, and they were like, what are you talking about, Tim? And of course, I mean, they're not traders, they're not on a trading desk, so they didn't know what ATR was, but he just could not talk about a stock without mentioning ATR. And so that just kind of speaks to like how important it is on our desk and just in general when we're thinking about the moves that these stocks are making on a day-to-day basis. All right, so let's go over the formula a little bit just so we can kind of understand specifically how this is developed. So it's the average range between each bar's high and low over a specific number of periods. So on the right here is the actual formula, and you can pause the screen and kind of write this down. You could go into your trading platform, and any trading platform is going to have an ATR indicator. I use one right on Thinkorswim. And if you look into the code, this is basically what it's going to be doing. And it's the true range, which is the max of the high minus the low, or the high minus the previous close, or the low minus the previous close. And that's basically saying the range of the candle, including any gaps that come from the previous candle. And then you just take the average of that over a time period. Okay, so like I said, any charting platform should have this. You can use it on any time frame. For example, on a 1-minute chart, the ATR is the average 1-minute range. So in this presentation, we're mostly going to be referring to the daily ATR, which is the average true range on a daily chart, the average range of a trading day. So one of the one of the really key things about this metric is that it allows us to normalize stocks. And so, like, what does normalize mean? Because this is really the root at how that gets to the root of how powerful this indicator is. Normalizing means to compare on a relative basis. Okay, so it allows us to adjust for differences between stocks so that we can measure them on an equal playing field. So if we're going to use ATR to normalize something, then we're going to compare a stock's movements on a relative scale. So this is really, really useful when we're comparing stocks with different prices and different volatilities. And so, for instance, say a $5 price move on a stock that typically has an ATR of $1 would be considered very significant, while the same $5 move on a stock with an ATR of $10 would be less notable. By comparing a stock's current price movement to its ATR, you're effectively normalizing its movement relative to its typical behavior. And this allows traders to gauge the significance of a price movement more accurately. So by normalizing using ATR, traders can compare movements on a relative scale, and this is especially useful when comparing assets with different prices or different volatilities. Just a little example on normalization, just to kind of bring it to life a little bit. Tesla is going to have a much larger daily ATR than Ford because Tesla moves more than Ford on average, right? So if Tesla has a $10 ATR, Ford is going to have like a 25 cents ATR, right? And that represents how much more on average, and this is daily, these are daily ATRs, how much more on average Tesla moves than Ford. So not only is Tesla a higher price stock than Ford, but it also makes larger percentage moves on average. So this is kind of a no-brainer. Like, we know Tesla's going to move more than Ford. But sometimes it's more subtle. So something like Berkshire Hathaway, BRK, is a higher price stock, right? Trading around $360 with a daily ATR of $4.40, while a stock like AMC is a much lower price stock, trading around $11 with an ATR of $4.50. So while BRKB is more than 70 times the price of AMC, they each have almost the exact same ATR. In fact, AMC a little bit higher. So this means just on average, they move about the same from high to low each day. And so this is something that really only ATR can tell us if we're looking at these stocks. So that we can see that a stock can be higher priced and not necessarily have a larger ATR, and a stock can make higher percentage moves on average and still not necessarily have a larger ATR. So there are three ways to normalize using ATR. Okay, so we can compare the stock to itself. So we can say this stock today is moving 3 times as much as it usually moves, right? That's how we can measure that using ATR. It's moved 3 ATRs off the open is something that we might say. We can compare stocks across the market, right? Multiple stocks. We can compare stocks to each other. And that's kind of like what we were just doing, right? With Ford and Tesla and stuff like that. But if we're looking at a universe of stocks, we can say, okay, you know what? Like, Google just moved 2 ATRs off the open while Microsoft only moved 1, right? And we don't have to compute in our heads, like, how much do they usually move? Like, what's the price of the stock? What's the percent move? The ATR just distills that movement down to like the simplest comparison possible. And then we can also compare across indicators. And this is a little more subtle, a little more nuanced. We're not really going to get into detail on this today. But the general idea is that all indicator readings, or a lot of them, are a product of the magnitude of the price moves that are going into them. Of course, indicators that are based off of price. And so you might have a very high price stock that moves a lot, feeding information into an indicator like, an RSI, a MACD, like whatever it is. And that indicator might act quite a bit different because it's a higher price, more volatile stock that's feeding information into it. So if you're interested in normalizing the activity of that indicator across stocks, you might actually use ATR instead of price movements. Okay, and so Tim Masters, who he's a really smart algorithmic trading expert. He has a great book called Statistically Sound Indicators for Financial Market Prediction. He said, and this just kind of speaks to how important ATR is, he says, how do we measure price volatility for scaling? There are an infinite number of choices, but my own favorite is average true range, which I believe best reflects true market volatility for scaling most indicators. So he likes ATR for this, right? There are other things that we can use to normalize movements in stocks, stuff like standard deviation, which is great, but I mean that's a crazy formula. I mean, who the hell knows how to write that formula? We're all traders. We want simple tools that speak directly to the goal we're trying to achieve, and ATR does this really well. So let's dive into some examples, all examples from yesterday on how to use this stuff. Okay, so none of these were cherry picked. I mean, this was basically like yesterday's trade, and we'll get into some of these. There are 3 ways to use ATR, general ways, right? You can use them to get targets, you can use them to get stops, and you can use them to measure overextensions. So this is kind of what we're going to go through here with some examples. So here's AFRM. This is a daily chart, and this is yesterday's close. Okay, so you can see 3 days ago, it had a big breakout, and that was earnings. So big volume, big breakout, and then an inside day the next day, and then day 3, a continuation breakout, right? And at the firm, we'll call this a day 3 breakout, where it breaks above the earnings day high after an inside day. And there was a good amount of volume on this day, but nothing compared to day 1. But this is a pretty good textbook day 3 breakout pattern that we're going to look at. And so often when something like this goes off the open and we're in it, right, we bought that breakout, we want to know, where can I expect this to go? Like, where can I start to look to take scales, right? And so using ATR is a way that on the desk we will look at levels to figure out, okay, like what might be a logical place to lighten up, like where can this go? So what we did here is we took one daily ATR and we extended it from the open, right? So we went to the daily chart, right? We went into our indicator, we figured out what is one ATR, and we basically transposed that onto our intraday chart to get us a price level that gives us a reasonable place for this to go. And so you can see here, like by 10:30, I mean, it had gone one ATR and a little bit more. And so when it goes in 1 hour, one daily price range, I mean, that's a pretty good move. And, one thing to keep in mind too in these situations is that the more volume it's doing, the more likelihood it's going to surpass one ATR, and it could do multiples of an ATR. And so on a day 1 move, we might actually be looking for, 1.5, 2, 3 ATRs. On a day 3 move with a little bit of less volume, we might just be looking for 1 ATR, just like AFRM did off the open yesterday. So just zooming in a little bit more just to kind of see how it looks when you might be trading it. And then another thing we can do to this same play is use an ATR trailing stop. So this is a different concept, and it's just another way to get out of a trade. And an ATR trailing stop is an indicator that you can get, again, like on any platform. I know Thinkorswim has it and others. And so this is what it looks like. Okay, this is an indicator that uses ATR. And what it does is that it trails a stop a certain amount of ATRs below the close from the last, in this case, the last 3 bars. So this is taking 3 1-minute bar ATRs from the lowest close over the last 3 bars, and it's trailing the stop that way. And the great part about this is that, as we know, ATR adjusts for the volatility of the stock. So the more volatile the stock, the looser the stop. If the stock gets more volatile, the ATRs will adjust for that, and it'll start to get priced into the indicator. And if volatility contracts, the same thing will happen, and the indicator will get tighter and tighter. And so it's a really great way to maybe, if you have trouble staying in a trade, use an ATR trailing stop, sometimes it can keep you in like longer than you might have been in if you didn't use it. And you can play around with different settings and stuff like this. And this one's a 3 ATR, 3-period trailing stop, and you can see it. It got us out around the same level as that 1 ATR, just on the other side. Here's another example from yesterday. PDD had earnings, and this was a day one earnings, and this exploded off the open on a lot of volume. And if you remember earlier, I said that when a stock is doing multiples of average volume, we're going to give it a little bit more room to go, because volume is like fuel. So especially with an earnings catalyst and a lot of relative volume, we're going to expect this to probably surpass 1 ATR if it's a good one, right? If it's strong on the tape, if it breaks out, everything this did. So PDD breaks out, and that first level on the chart is 1 ATR, and that second level is 1.5. So this went 1.5 daily ATRs from the open. And you can play with this, right? Like, you might have setups, and you might find that for your setup, they typically go 1 ATR, and that's kind of a place that you want to target. You might find that you trade really explosive catalysts and earnings plays on day one, and that you're actually finding that you're targeting 2 ATRs or even 3. So you have to cater that to your own setup. But these are just examples of how we can relatively look at these price moves at the open and kind of get some perspective on, okay, like, how far has this gone? Same thing, just zooming in to see how this might look when you're trading it. And then let's apply that trailing stop. Same thing, that 3 1-minute bar ATRs from the lowest close over the last 3 bars. And it's very similar, right? Kind of keeps you in the trade and then stops you out when it starts to roll over. All right, here's PDD on the same day, but we're just zooming out a little bit. And we've drawn a pre-market level that was a pretty significant level in the morning before the open. And if you were trading this and you were kind of buying it like off the open, say like on the first candle, and you wanted to put a stop below this significant pre-market level, you might put a stop right at that level, but you also might give it a little bit more room, because as we know, the stocks like to wick through these levels and reclaim, especially right at the opens, right? So if I'm trading this and I think that that's a significant level, and I have some from the pre-market, or I'm buying it at the open, like, I really want to see it hold below that level for me to get out. I'm not really just going to put a kill stop like right there at that level, because the chances that I'm going to get wicked out are like really high, especially, at 931, 932. And that's really what happened. And so one thing you can do is that you can use its daily ATR as a reference point, and you can use a percentage of that ATR and actually extend your stop below that level. So it's like giving the stock a little bit of extra room below the level, right? And if you're writing algorithms, if you're writing models that actually have to know like where these stops are going, this is a really good practice. You can use ATR to sort of inform the model as to how much room it should be giving it below each stop. And the nice part about that is that you can be trading different stocks, and you can be using ATR to normalize that distance, right? So this PDD stock is going to have a certain range. And so in this case, 10% of a daily ATR below this level is going to represent 10% of PDD's typical daily range. And so if you're doing this to CMG with a really high price stock that has prices in the thousands, this is going to be a much larger distance, but relatively speaking, it's going to give it an appropriate distance from that stop. And again, like if you're trading a really low price stock, it's going to do the same thing, where it might actually just give you a few pennies. Okay, so it's a great way to adjust that space if you're trading a lot of different tickers. All right, and here's our third example. This is VFS from yesterday, and this was an overextension play. You can see it went 5 days in a row as volume started to come into the stock. And here's something you can do with ATR to kind of get a level and a gauge on maybe some of these overextension plays on the daily chart. Is you can think about, okay, like how far has it gone in 5 days? So in this case, if you extend 4.5 daily ATRs in 5 days, like from that 5-day low, you're going to get that level where it topped out at. And this is something you can study. Like if you have setups like this, you can go back, you can look at, okay, how far do they usually go before they start topping out? You know, I like to use 5. This one went 4.5, very close, right? But sometimes these are good levels. They're good levels just for reference, just to kind of understand, okay, you know, if it's only gone 3, you can know, well, you know what, like that's not really extended considering, you know, all the examples I have and my typical expectations for these plays. So just zooming in to an hourly and then zooming in a little bit more to the 15-minute just to see that level. This is something that you can experiment with, right? And so again, we're asking the question, how many ATRs, how many daily ATRs has this stock gone in 5 days, right? So you take the low from the last 5 days and you extend that multiple of ATRs above that low. So in this case, 4.5 above the low, and it gives us this price level. And then, of course, there are Keltner channels. Similar idea, kind of measuring a number of ATRs from a moving average. And this is something that we covered in a recent video that actually got a lot of requests for this ATR video because these Keltner channels are based on ATR. So if you want to check out this video, we'll link it above. So look, you can see this metric can be used in a lot of cases. And if you like to create algos that rely on raw data, then this is a Swiss Army knife, really. And if you're fully discretionary trader making decisions off of feel, this can be a great reference point. So at the very least, it's the way traders communicate, right? So if you want to understand the next call out or have an easier time describing the move that your stock made to a trading partner, ATR is a great way to do it. So please, as always, put your questions down below. I'll get to answering them. We'd love to know how all of you are using ATR in your trading. I really enjoy throwing educational nuggets your way and getting to, getting ideas thrown right back at me. It's part of what makes this community so great. As always, you can follow me on Twitter in the link below. Until next time, cheers.
So you're an active trader, not doing as well as you want, not doing as well as you deserve, and you just can't figure out why you can't become profitable no matter how hard you try. Well, let me show you why. This is your competition. The traders in this room. This room right here is full of elite traders, some of whom are making 7 and even 8 figures a year. In fact, our top guys have made nearly 20 million each in net trading profits in a single year. Let's head to my office so I can share more. So you're probably used to seeing videos of lavish trader lifestyles, trading gurus trading off of a laptop for an hour a day, heck, maybe even 15 minutes a day, and then them relaxing on some secluded beach for the rest of the day. Well, all I can tell you is that our traders train like pro athletes. They live and breathe the markets and are continually working on their trading skills. Because at our firm, that's what we found it really takes to make it in this game. I'm Mike Bellafiore, co-founder and managing partner of S&B Capital, one of the world's top proprietary trading firms located in Midtown Manhattan. And we're always looking for trading talent to hire and develop. And not just to trade in-house on our desk, but also to trade from their own home, entirely using our firm's capital. And we have numerous traders doing just that, allowing them to make upwards of 7 figures trading the firm's capital without risking their own money. But to even get a shot at something like that, you need to have the right training. That's why we're doing a new free online presentation in which we share how you can get an interview with SMB to become an in-house or remote trader, trading firm capital without risking yours and gaining access to all of our firm's coaching and resources. And the best part? You don't have to be a profitable trader yet. In fact, we prefer to mold profitable traders with our methods and our techniques. That's why we have just 3 simple criteria that can earn anyone an interview. We're looking for highly ambitious and determined traders who fit our culture first and foremost. So if you believe that could be you, sign up for the free 1-hour online presentation by clicking the link that's in your top right corner of your screen now.